While U.S. equities are keeping it relatively cool today, using cool in the loosest sense given this mentally draining week that traders have faced, other markets are sounding alarm bells, and those alarms are getting louder and more dangerous with each passing moment. Charles Schwab's Kathy Jones put it simply, the market is losing confidence in U.S. policy. Wild swings in tariff decisions have wreaked havoc on leveraged trades. Buyers are stepping back, volatility is kicking up, and liquidity, it's drying up fast. This isn't your typical market slowdown. JP Morgan points to prices swinging wildly even when trading volumes are low. Imagine a market walking on thin air. Every small step risks a large tumble or an unexpected leap like hitting a pothole at high speed. With fewer buyers in the market, there's no one to catch falling prices, causing them to plummet fast. And fewer sellers mean rapid spikes due to unfilled large buy orders. In response, gold is reaching record highs, a classic signal that investors are seeking shelter in hard assets amid fiat uncertainty. Now the Federal Reserve finds itself in a pressure cooker. Boston Fed's Susan Collins has said they're ready to stabilize markets, but the markets seem unconvinced. As Goldman's John Flood observes, the stock market is no longer leading the charge. The real action is now in the dollar and bond yields. Here's your macro puzzle of the day. Despite stocks selling off, why are long-term yields rising? Let me explain. During a stock market crash, capital flows out of stocks into safer assets like U.S. Treasury bonds, pushing bond prices up and yields down as investors seek security. According to Torsten Slok, there are three main reasons for this anomaly. Foreign investors might be offloading U.S. bonds, currencies like the yen and euro are gaining strength, and the VIX, Wall Street's fear index, is near 50, indicating heavy hedging and risk-off behavior. The most significant concern, however, is nearly $1 trillion tied up in complex basis trades, potentially unraveling, especially among highly leveraged hedge funds. Put it all together, and the result is a perfect storm. Rising yields, declining confidence, and swelling systemic stress. Fed official Neil Kashkari comments that there's no immediate need to intervene despite the visible stress. They're observing, but hesitant to move unless the situation worsens significantly. Bloomberg's David Wilcox warns of a larger issue. The Supreme Court's approval of Trump's move to fire independent agency heads, a protection Fed governors also rely on, isn't just a political maneuver. It's a strike at the Fed's independence. Finally, Deutsche Bank's George Saravellos sums it up. The world is reassessing the dollar's status as the global reserve currency. This could be the start of de-dollarization, with current market prices broadcasting the message loud and clear. Subscribe for real-time macro market breakdowns. We're not just watching the markets, we're decoding them. This is Macro Junkie.